Companies listed on Nairobi Securities Exchange are paying shareholders roughly 75 billion in dividends. Safaricom leads in this payout with a total of 46.08 billion payout, which will be dispersed on September 4th to all shareholders registered on the company books by the August 4th cutoff date. And this is great news not only for institutional shareholders like the National Social Security Fund and other pension schemes, but also retail investors. The payout also highlights strong performance by the telecommunication giant, mainly driven by the high performance in mobile money and data services. Actually, Safaricom's market capitalization has grown to about 1.44 trillion Kenyan shillings, which is about 11 billion US dollars, and this follows its expansion to Ethiopia. And this is good news for investors. Safaricom is one of dividend paying stocks in Kenya, and in fact, Safaricom shareholders have received approximately 280 billion shillings in cumulative dividends over the past 5 years. And Safaricom is not the only company paying dividends this time. The remaining 26 billion is being paid by other companies like the East African Breweries Limited, KCB Group, BET Kenya. You have Stanbic Holdings, Absa Bank Kenya, and NCBA Group. And one striking detail of this payout is that about 45%, or roughly 33 billion Kenyan shillings, could leave Kenya because of multinational shareholders owning stakes in some of these companies. But that's not a must because, of course, some investors may choose to reinvest their dividend income. And from this development, we can see dividend income is one of the ways to earn from the stock market. But that's not the only way. There is also capital appreciation. So in this video, I want us to answer this question. Between dividend income and capital appreciation, which one is better? Should you focus on companies that pay large dividends, or should you buy companies with strong growth potential even if they pay little or no dividends? Let's start with dividend. So what is a dividend? A dividend is money a company distributes to its shareholders from its profits. Imagine you buy shares in a company, the company makes a profit, the directors decide that part of that profit should be distributed to shareholders. So you receive money based on the number of shares you own. For example, suppose you own 10,000 shares and the company declares a dividend of 2 shillings per share. So you would receive 10,000 times 2. That's 20,000. That's dividend income. And importantly, you don't necessarily have to sell your shares to receive it. You can continue owning the shares or receiving dividends when the company declares it or declares them. This is why dividend paying stocks are attractive to investors looking for income. But there is a catch. Dividends are not free money. When a company pays dividends, money leaves the company and goes to shareholders. That money could otherwise have been used by the company to expand or buy equipment, enter new markets, or develop new products, or reduce debt. Therefore, a company paying a large dividend isn't automatically a better company. Sometimes a company that pays a smaller dividend or no dividend at all can potentially create more wealth for shareholders by reinvesting its profits into profitable growth. And this brings us to the second way investors make money, which is capital appreciation. So what is capital appreciation? Capital appreciation simply means that the value of your investment increases. Let's say you buy 10,000 shares at 20 shillings per share. Your investment is 10,000 times 20, which is 200,000. 5 years later, suppose those shares are trading at 50 shillings per share. Now your investment is now at 10,000 times 50, which is 500,000. You have gained 300,000. That's capital appreciation. You haven't necessarily received any cash from the company. Instead, the market value of your shares has increased. If you sell your shares at 50 shillings per share, you realize or you get the gain. Now we have two different ways of making money. Dividend income, the company gives you cash, and capital appreciation, the value of your investment increases. And this creates an important distinction. With dividends, you are receiving income. With capital appreciation, you're building wealth through the increasing value of your asset. But which one is better? There is no universal winner. It depends on your age, financial goals, your income needs, risk tolerance, and investment horizon. But if your primary objective is long term wealth accumulation, capital appreciation can be extremely powerful. Why? Because a successful growing company can potentially reinvest its profits and increase its earnings over many years. As the business grows, the value of the company can grow, and consequently, the value of your shares can increase. Also, capital appreciation can be powerful for younger investors. Let's say you are 25 or 30 years old. You don't necessarily need your investments to generate a large amount of cash today. You might have decades before retirement, and in that situation, you may be more interested in companies that can grow significantly over the long term. You could potentially allow your investment to compound for 20 or even 30 years. Instead of taking the income today, the company may reinvest profits and grow the business, and that growth can potentially translate into a higher share price over time. And this is one reason younger investors may want to focus on total return and growth rather than simply chasing the highest dividend yield. But dividends become more attractive when you need income. Imagine you are approaching retirement. Your priorities may change. You may not be as interested in whether a company can double in size over the next 20 years. You might instead want investments that generate relatively predictable income. That's where dividend paying investments can become particularly attractive. Suppose you have built a portfolio worth 10 million shillings. If that portfolio generates an average dividend income of 5% a year, that's potentially 500,000 per year before applicable taxes. And assuming the dividend rate remains unchanged, that could provide an additional source of income without necessarily requiring you to sell your investments. This can be valuable during retirement. But remember, dividends are not guaranteed. This is extremely important. A company doesn't owe you the same dividend every year forever. If profits fall, the company can reduce the dividend. It can suspend the dividend, or it can decide to retain more profits for the business. Therefore, you should not treat dividend income like a guaranteed salary. Now, let's review the problem of chasing high dividends. This is another important thing. As an investor, don't chase high dividends. This is a mistake many beginner investors make. They search for the company with the highest dividend yield. They see one company offering like 12%, another one 7%, another offers 4%, and they immediately think, I will take the 12%, but that's not necessarily the right approach. Why is the company paying 12% or 10%? Is the company growing? Are profits sustainable? Is the dividend coming from strong cash flows? Is there Is the share price falling? Could the dividend be cut? A high dividend yield can sometimes be an opportunity, but it can also be a warning sign. You need to investigate and find out before investing. Now, here is something that might surprise you. A company paying a small dividend can potentially be a better investment than a company paying a huge dividend. Why? Because the company may be using its profits to grow. Imagine a company earns 1 billion shillings in a year. It could distribute 800 million to shareholders, or it could distribute 200 million and reinvest 800 million into expanding the business. If that investment generates strong returns, the company could become much more valuable in the future, and shareholders could potentially benefit through capital appreciation. This is why dividend payout isn't the only measure of a good investment. And don't get me wrong, I'm not saying targeting dividend income is wrong. If you are able to build a portfolio of dividend paying companies, every year some of those companies distribute part of their profits to you. You can use that money to pay bills, supplement your salary, fund your retirement, save it, or even build another investment. You can also choose to reinvest, where you buy more shares, and those additional shares can generate more dividends. Then you reinvest those dividends again. Over many years, you can create a compounding effect. This means dividend in investing doesn't have to be purely about income. You can turn dividend income into future capital growth and more dividend income. That's why reinvesting dividends can dramatically change the long-term outcome of an investment portfolio. Now, which strategy would I choose? Well, I will choose both. Buy some dividend paying stocks, then buy some growth stocks. But if I were building wealth from a relatively small amount of money and had a long investment horizon, I would not focus exclusively on dividends. I would focus on quality businesses and total return. That means looking for companies with strong businesses, sustainable profits, good management, reasonable debt, strong cash generation, potential for long-term growth, and where possible, a history of rewarding shareholders. If the company pays dividends, that's a bonus. If it also appreciates value, that's even better. The goal is not simply how much dividend can I get this year. The goal is how much wealth can this investment potentially create over the next 10, 20, or 30 years. So that's all from me today. I hope this information is helpful to you. Thanks for watching, and don't forget to like this video and subscribe to the channel if it's your first time here. I'll see you in the next one.